The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. AB InBev earnings on tap. The world's largest brewer posts record revenue for the full year, but overall volumes decline. Juliana will be speaking to the CEO, Mikhail Dakaris, at 7:15 GMT. The US and Ukraine reportedly strike a deal over critical mineral resources, raising hopes for improved relations between Kyiv and the Trump administration.
Tesla's market cap falls below $1 trillion as a 25% drop this year nearly wipes out the stock's post-election gains. And Germany's Chancellor-in-waiting, Friedrich Merz, rules out imminent changes to the country's strict debt rules, whilst Bundesbank President Joachim Nagel tells CNBC he welcomes talk of reform.
It's important to discuss what could be necessary to have such a reform, because the world changed over the last 15 years since the debt brake in 2009 was introduced. Many new uncertainties.
And with that in mind, beware the bond vigilantes. Look at the number on the screen, ladies and gentlemen. The warning from the IIF is be careful as global debt levels reach a record $318 trillion at the end of 2024. So in recent days, we've spoken to the likes of Carlsberg, we've spoken to Heineken as well. We didn't speak to Diageo because they pulled the conversation because the earnings weren't going to be great. But we have got a conversation with one of the biggest brewers on the planet, that is AB InBev. And ahead of that, Juliana joins us from Leuven with more. Juliana, what have you garnered from that wealth of paper that they've given you and that's in your hands?
Well, Steve, it's quite a stack of papers, and I've had a minute or two to go through the numbers. And the focus this earnings season is around volumes. And as you said, we've heard from a number of brewers already, and we've seen a pullback in volumes. The question on investors' minds, to what extent is this pullback cyclical or structural? So what we've heard from AB InBev today is that they have seen a decline in volumes over the course of the fourth quarter and over the course of the year. But encouragingly, it looks like the decline in volumes has moderated somewhat. So for Q4, volumes are down 1.9%. When we were looking at Q3 numbers, volumes were down 2.4%. Revenues for the fourth quarter actually increased 3.4% higher. That was better than the market had been expecting. And EBITDA was much better than the market had been expecting. 10.1% EBITDA growth in the fourth quarter. For the full year, EBITDA growth was 8.2% better than the company had guided. They'd given a range of 6 to 8%. So better than expected in terms of full year EBITDA growth. Why? Well, cost discipline, margin expansion seem to be the reason. Now, in terms of the detail, what's behind these numbers, they are seeing continued weakness in China and Argentina. And they actually say on the volume front, if you exclude those two countries, volumes actually expanded overall over the course of 2024. Premiumization continues to be a big trend for AB InBev. No alcohol, which is a big theme in the beverages industry. Their no alcohol portfolio saw low 20s revenue growth in 2024. They say that they estimate they gained share globally on this front. They also saw Beyond Beer grow modestly overall. So I think on the whole, investors should be pretty pleased with these numbers. A guidance beat in terms of the outlook for 2025. They're saying 4 to 8% EBITDA growth is expected. So yes, volumes have declined for AB InBev, but they seem to be making up for that in margin expansion, cost discipline. So pretty good on the profitability front. They also announced a dividend of €1 per share as part of their full year result. But as I said, coming back to the beginning, there is still this overarching question hanging over the industry, and that that is to what extent this pullback that we have seen in volumes is structural or cyclical. And if you're taking the view that it's structural, then you might want to get involved in a play that's more exposed to emerging markets, and that is AB InBev. They've got massive exposure to South America, and if you are looking at a structural decline in volumes, then you want to be in a company in a portfolio that is more exposed to EM because there's still a bigger opportunity for structural growth. So that is one of the questions I will be putting to the CEO of AB InBev, Michel Ducaris. I'm going to be speaking to him at 8:15 CET, so I'd stick around for that one.
All right, fabulous. Thank you very much indeed for that, Juliana. Very comprehensive, given the fact that you had probably 64 seconds to read through the numbers. Well played to you.
Very difficult industry now, isn't it? As we talk about sustainability, number one, changing habits by the consumer, trade tariffs as well. So just how defensive is the sector in 2025?
Absolutely, and changing drinking habits has been something we've talked about a lot this year, this century, beg your pardon. But also, do you remember, 5 to 7 years ago, the conversation was all about craft. Craft this, craft that. Microbrewing. And then they bought up all the microbrewers and it still didn't boost their numbers. So it's quite fascinating. Or maybe it did boost their numbers, and the counterfactual was if they hadn't bought up the craft brewers, they would have fallen even more.
Right, but zero alcohol, as we've seen from other rival producers, is actually having a bigger pop in the numbers.
Even Karen Cho,
the premiumization in the portfolio, which is quite stunning.
Are you zebra drinking?
Zebra drinking.
Zebra drinking is a thing, I'm told, amongst the Gen Zers, where you have one alcoholic drink, one non-alcoholic drink, one alcoholic, one non-alcoholic.
Right.
It's a thing.
But you were actually more one colour. You're just the non-alcoholic.
I don't drink.
Yeah, exactly.
Yeah.
What sort of zebra is that? Let's push on. Ukraine has reportedly agreed a critical minerals deal with the United States. That's according to multiple media outlets citing Ukrainian officials. The agreement reportedly does not specify any US security guarantees or a continued flow of artillery for Ukraine. But according to reports by the Financial Times and Sky News, Kyiv agreed after the US dropped a controversial demand for a right to $500 billion in potential revenue. US President Donald Trump seemed to confirm on Tuesday that Ukrainian President Volodymyr Zelensky will travel to Washington later this week to sign the deal. Meanwhile, UK Prime Minister Keir Starmer has announced defence spending will increase to 2.5% of GDP by the end of 2027. Starmer told the Commons the move will translate to £13.4 billion in extra spending annually, with cuts to foreign aid helping to fund the move. Starmer made the announcements ahead of his visit to Washington, where he will meet President Trump tomorrow. The UK leader said that the defence decision was, quote, 3 years in the making, but had been accelerated by Trump taking office.
Yes, it's true. President Trump thinks we should do more, and I agree with him. It chimes with my thinking on this. And by more, I mean more capability, I mean more coordination, and I need more spending. And we have to learn the lessons of the conflict, particularly when it comes to capability and coordination. The war being fought in Ukraine, I felt this very strongly when I was there a few weeks ago, is being fought now in a very different way to the way it was being fought just 3 years ago.
Let's revisit those defence names and how they're performing year to date. We've been talking about this around the European decisions to beef up spending. And of course, now the UK also making that pivotal decision. Rheinmetall, Rank, BAE Systems, some of the big improvers so far this year. And you can see those gains year to date. They look more like technology names, not defence stocks, don't they, with those monster gains, 55% on Rheinmetall.
Names are down now.
Right. The 2024 performance of some of those tech names.
Isn't it?
It is indeed. I want to pick up on the point here because I do wonder where that leaves aid. The US made a very similar decision. It froze for 90 days some of the spending on foreign aid, but also took down one of the key agencies deploying capital to other nations across the world. Now the UK making the decision, so it's very much my own backyard first. So the foreign aid is being sacrificed here for the beefed up spending on defence. So it doesn't feel like it's just going to stop with two countries making that decision. Where does it leave international players? And don't forget, on the back of the US announcement, it was the UK saying this leaves an avenue for China to increase its global influence. Is it now low-hanging fruit instead of all those bridging loans and infrastructure programs that the Chinese did? Now it's just foreign aid where the Chinese can make some inroads in terms of international relations.
I wasn't going to go down that route, but I will follow you down that route because I've actually done a bit of work on this one. This is all about soft diplomacy as well. And one thing I will say is, despite those age budgets, and I actually had a very interesting conversation with the leader of USAID when we were both in Krakow at the start of the war as well. She was a Democrat hire, by the way. But it was very interesting that despite the aid programs of the US and the United Kingdom and others as well, that hasn't stopped the Chinese actually filling the space that was left in terms of vacuum by the US and UK pulling back from other, perhaps harder diplomacy and harder policy areas as well. So whilst I'm a huge, obviously, fan of aid where it's needed and what have you in the world, the fact of the matter is that aid support hasn't led to a warmer attitude to the liberal democracies in the West from the global South as well. The Chinese were filling that gap anyway, but I hear your point about the low-hanging fruit being left for the Chinese were they to fill that aid gap. I do want to go back onto the defence of Europe side of things as well and pick up on those Sir Keir Starmer comments as well, because there are two things going on here and they are interrelated, but they are different at the same time. One is the support for Ukraine, which of course appears to have shifted dramatically since the Trump administration, since the interventions from J.D. Vance at the Munich Security Conference, from Pete Hegseth's comments as well. But perhaps more worryingly for the West, for liberal democracies, is the fact that the US has had their back in post-war architecture since the late 1940s. That appears to have shifted dramatically, and I think that is very important for all of these Western nations. It has huge ramifications for their debt levels as well, and we'll talk about debt a lot later on the show. Whether it be the United Kingdom, France, Germany and others are scrambling for a new security policy. And this is very important. And I just want to comment briefly on something that Martin Wolf in the Financial Times has pointed out as well. I've spoken to Martin a lot, actually, off camera about European defence over the years. And we've disagreed on a lot of things as well. But this is now what he's saying. And I think this is stark. This is one person's view, but it's a person who has a great insight into what's going on. I won't go into the whole article. I'll just read you a couple of lines from it. The US is now the enemy of the West. This is one of the lead opinion writers in the Financial Times. It's his opinion, it's no one else's, but I just want to tell you what, because it gives an example of the shift in thinking. The US is now the enemy of the West. Washington has decided to abandon both Ukraine and its post-war role in the world. And I think when you've got very important, influential thinkers, such as Martin, making those kind of comments, that just shows you what the ripple effect through the political systems in Berlin, Paris, London, etc. is going on at the moment, and the change in the mindset.
Which some would say benefits the likes of Putin and Xi. This is exactly what some don't want to see happen, because it emboldens those in other countries that are actually seen as the true enemy to the state.
I will pick up on that and say yes and no. Yes, the US pulling back is a dangerous signal, but my goodness me, there is an opportunity for Europe and the West, and we can include Canada, Australia, and New Zealand into this as well, and other allies as well. There is an opportunity to get serious, certainly in Western Europe, about your own defence as well. And given the fact you say it emboldened Putin, I think you're right on one level, of course, with the US pulling back. That's unarguable. But since Putin started this war, by the way, he started two wars, one in 2014, latter in 2022, the border with NATO countries has grown dramatically. The defence of the Baltic region has grown dramatically with Sweden and Finland, who bring huge military potential to that area of the world as well. So on one level, you're right. Putin's rapprochement with Trump is dramatic. But actually, if the West is actually beefing up its military and taking seriously its military, including the Poles who are going to 5% of GDP, is that a victory for Vladimir Putin?
Well, to your point around the clear and present danger being Russia on this side of the world, I would say elsewhere it's still seen as China. And don't forget, the Australians have had some saber rattling in international waters very close to Australia in recent days. So I think the argument there is for Australia to also beef up its security to counteract the Chinese. So where does the money come from? We go back to that situation before we even talk about debt later on. Foreign aid. It seems like the domestic spending budgets are already so full that it's going to come from elsewhere. Ahead on the show, Tesla shares hit reverse, booting the EV maker out of the $1 trillion club. We'll bring you that story later this hour. Plus, global debt cracks fresh records. We'll have more for you ahead on the show. And it's another bumper earnings day across Europe. Stay tuned for our exclusive interview with the AB InBev CEO, Michel Decaris. That is coming up at 7:15 GMT. Investors still proving somewhat cautious around the data and whether growth is being derailed by the tariff threat. Now, US consumer confidence fell at the fastest monthly pace in over 3 years in February, dropping 7 points to 98.3. That is well below analyst expectations and marks the first reading below the key 100 level since June 2024. I'll look at the US market reaction in that context, and you can see it was somewhat of a mixed picture. The Nasdaq and the S&P 500 still showing some selling pressure. It was the Nasdaq again a day earlier. Stocks being hit, the likes of Nvidia, and this is the stagflation threat that's been cropping up on markets. Investors closely eyeing what that could mean if we are talking about higher inflation, what it means for some of those high-priced growth stocks. Another feature to the market, don't forget Nvidia reporting after the bell. And there's been a lot of caution around the DeepSeek news story, tariffs as well, and what that means for the company. So it has been one of the laggards on both the S&P and also the Nasdaq. You can see the Dow stretching out its performance again, up almost 0.4% in session. Home Depot, one of the movers there, and that really is the nature of the rotation you're seeing. It was communication services to the downside. Consumer staples was one of the better performers in session. Well, to treasuries, this is where we've seen some of the yields mark lower despite some of those fears around what we're seeing on inflation. And the yield this morning we're 4.12, the 10-year sitting at 4.32, but that 10-year slumped about 10 basis points around to the lower levels we're seeing on the charts in session yesterday. Lows not seen since mid-December when it clocked up a 4.28% level yesterday. So the market is seeing a little bit of movement around these yields on market. I want to take you to WTI Brent gold, the commodity trades today. We are slightly higher again on WTI and Brent, 69 the handle on WTI Brent, $73. Spot gold giving back a little bit of territory but holding the $2,900 line. Asian markets picking up on that mixed bag from Wall Street. It looks again mixed across the region. We've got Japanese stocks giving back some territory, but Hong Kong, very strong pop. We're seeing that market climb 3.25%. So it looks like the consolidation phase after the DeepSeek news may be done for now. And we have a very strong trade unfolding there, Steve. A
quick look at Deutsche Telekom, because we've got so many great CEOs waiting in the wings as well. They've had a massive rally off their lows, 21% higher year to date. But actually from April last year, they've rallied from round about, great chart, thank you team. They've rallied from round about 21 euros to the 35 euros you can see on the screen. Latest numbers, full year 2024 adjusted EBITDA AL up 6.2% year on year. Karen.
And let's push on to Fresenius. It has met its upgraded outlook in the full year results, posting earnings per share of €2.59 on the back of 21.5 billion euros in revenue. However, that revenue figure came in below analyst estimates compiled by LSEG. The German firm says it expects revenue growth of up to 6% this year. Michael Sen joins us again, the CEO of Fresenius. Michael, thank you so much for joining us. Welcome back. Just flesh out the latest quarter. What were the highlights for you?
Well, thanks, Karen, for having me on the show. Hello, Steve. Look, when we started 2 years ago on your very show, I said we are about to create a stronger and more focused company. And 2024, including the fourth quarter, was a phenomenal year. The team delivered revenue up, high single-digit growth, nice drop through into operating earnings, up 10%, margin expansion, and net income even up 13% year over year. This has all been paced by what we call the growth vectors, biopharma, medtech, clinical nutrition. People view this as the catalysts, the value drivers. And also the only number which should go down came down materially, which is our leverage. We ended the leverage at 3 times net debt over EBITDA. And going forward, we even going to improve on that one. And this positive momentum will continue in 2024. We are advancing and pretty excited about some launch and commercial milestones coming in 25. And therefore, we are still on our path to create shareholder return. And we will continue to focus on performance and delivery.
Michael, I want to just pivot to what we're seeing in the numbers, the high-quality IV therapy products that are showing some success. You've upgraded the margin ambitions for Kabi. Explain where this is coming from, why you're seeing the demand for this business in particular.
When you look at the composition of Kabi, it has great businesses, clinical nutrition, medical technology, IV generics, and then there is biopharma. Biopharma in 2025 is really becoming a real business. In the last couple of years, it moved from an investment case now to really growing. It had been growing last year by 75%. It's roughly 600 million. We say in the next 2 to 3 years, this will be a billion business and will get close in the next 2 to 3 years to being margin accretive, coming from an investment case, really being margin accretive. Biosimilars are basically medications for oncology, autoimmune therapy, highly innovative, and we are making that accessible to patients all over the world, and especially next year in the US. And one particular molecule is leading the way, which is called tocilizumab, and we have 2 other molecules coming. This is what I meant with exciting launches coming into 2025.
Michael, lovely to see you. Finally, we get to interview. Karen's been having the joy of speaking to you many times. I only see you on the street in Davos, so lovely to see you. Germany's election leaves its industrial champions dangling. That's what the FT said. Do you agree?
Well, Germany has homework to do. I would call Germany a clear turnaround case. Turnaround case, not a restructuring. Turnaround case means there are some great fundamentals, but you need to do something different. What Germany needs now is clarity, the right focus, and obviously a clear mindset and mode of operation on deliverables and action. The time of talking about wake-up calls is over. We need an action plan for Germany, and it should focus on economic growth and competitiveness. And we did talk about economic growth and competitiveness. That is the means to get a seat on the table in the international arena. And talking about a strong economy, it obviously needs to entail the healthcare industry, because the healthcare industry is a growth industry. It is highly innovative. It creates jobs, and it also plays a critical role when we talk about national security.
Michael, I've just promoted you to key advisor to Friedrich Merz for the next 3 minutes. Give me one policy that Germany can do that will absolutely tick the most box straight away with the easiest simplicity.
I think there are a few direct wins on the whole bureaucracy topic. You can cut the reporting. You need clear deliverables early. You can ease the pain on data security. Even within Europe, we have a hospital chain in Spain and we have a hospital chain in Germany, and you see that we have different procedures. Spain, by the way, is more advanced. If we cut this one, we can unleash innovation in the hospital sector, which will bend the cost curve and will benefit patients.
Michael, I was just pouring through the results still, and the 3 different segments that you talk about, the US has been pivotal to the performance. How concerned are you about Trump policies as he pledges to sit down with big pharma leaders?
I think what is clear, Karen, is that President Trump has a clear agenda. There are 2 topics which we're closely observing. The one is obviously how he's addressing the trade deficit and the news flow on tariffs. We view this as an invitation to show what we can bring to the table, how strong we are actually in the US. I started a campaign last year in the US, which was called More in America. And this is to show that the bulk of what we provide into the US is manufactured, is distributed, is warehoused, and is seamlessly integrated in the US hospital system. Also, what we provide is essential medicine, life-saving medicine to keep the system afloat. So very good arguments there when it comes to how the administration is addressing the tariff. And then there's the whole topic of workforce reduction. Also, that one we're observing closely. We have not seen any disruption, but we are closely monitoring because we want to ensure that patients do get access to affordable medicine, which is what we are providing. All in all, it's not too bad to think about making authorities, institutions, regulatory bodies more efficient. We even have ideas, for example, on exactly our biosimilars business. How can you get this faster to patients on the regulatory approval path without sacrificing on quality and safety?
Michael, we all know that US healthcare is extremely expensive. Trump may be angling just to take down the pricing. If you are forced into some sort of price cuts, what impact would that have on the business?
Well, we are in the generics business, and the biosimilars business is also, let's say, the next generation of generics based on biologicals. This is a highly competitive market where there is already a lot of price competition today. By the way, that price competition leads to the country being in drug shortage. So actually, you want to address the drug shortage. By the same token, you want to bend the cost curve. 17.5% healthcare spend in terms of GDP in the US, which rose 7.5% year over year in 24. You know, what you can really drive into the system is access to affordable medicine on biosimilars, which have a totally different price point than the originator product. If you make that one easier, you do something good for patients, you save lives, and by the same token, bend the cost curves, and also, you know, give benefit to those who really have a high value add manufacturer in the US and still have competitive prices. So we bring a lot to the table to exactly bend that cost curve.
Michael, just a quick one on the other side of the world. China. Europe, if it is unsure about its relationship with the United States, is going to have an even more complicated relationship with China. It wants to build links. It wants to build two-way trade. But there are problems about perhaps Chinese medical devices and curbs on those from EU as well. How does China look to you, and how important is China?
Well, China is important for every company also in the healthcare sector. It's one of the largest markets. But I've been on the record for the last roughly 1.5 years that I said China is going to be soft out of many reasons. There was the general economic weakness. Then there was this whole endeavor on, you know, having regulatory rules, which they called compliance procedures going forward. And then, of course, you see that China is moving to a volume-based procurement model, a different model of procuring, which has price pressure. So in China, we expect in 25 that it's going to be soft. That is nothing new for the market. We are addressing this one, also going on the cost side, and obviously growing in other geographies. This is what you do. You diversify and put your eggs in many baskets.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.